Market Trust is a kind of Luxembourgese startup company, and they are active in different fields. They are one of the main sponsors of our conference, and actually they have good news. They won very recently the award in Luxembourg as the startup of the year in this field. So congratulations.
Thank you.
And they are going to speak about how to rate Cocos, and especially in the European perspective. We give the floor to Casimir, and he's head of research and development. Is that correct?
Yes.
Okay. So go ahead.
So thank you. Okay, so my name is Casimir, and I'm head of the research and development at the Market Trust. And so today we are going to talk about rating of contingent convertible bonds, and at the end I will give the floor to the CEO of our company, Evangelos, to give you a brief introduction about what we do. So we live in a society which is getting older and older. This increases the liabilities of pension funds and other types of institutional investors. So they need to find a way to increase the yield on their assets. At the same time, the same demographic developments are, in part at least, the reason why we have persistently low or even negative interest rates. And this is of course not favorable for standard bonds and credit returns. Today, as we speak, you basically give money to Germany for the privilege to lend them over as much as 5 years. The yields or even 10-year bonds are pretty low. So these are safe assets, but they will not really save us. Coco bonds represent a quite attractive alternative. So as we saw within the previous speakers, they have yields which pretty much fit into what a pension fund or other type of institutional investors is going to expect. So of course the question is how to measure the risk in Coco bonds. In particular, how to measure the risk from a more kind of a long-term perspective. So for over 8 years, professional investors have relied on credit rating agencies to receive this type of long-term strategic assessments of the risk of many types of products in fixed income markets. The chart here shows what happened during the 2007-2008 crisis. As you know, it basically shows the number of downgrades of structured products during that period, and you can see here a big spike. So essentially there is a spike in downgrades from rating agencies, which happens weeks and months and even years after the market already has sold down. So it has been kind of a rise, but a little bit late. So at the same time, or because of that, so many people have kind of said, well, okay, so we don't really care that much about rating agencies. So how about trying to find on the markets like observable parameters or observable metrics which can help us to measure the risk in the forward period? And indeed, for instance, we have on the stock markets, we have quite liquid options, and from the options, using pretty simple theory, we can extract the implied volatility. So I have charted here the Euro Stoxx 50 in 2007-2008. On the horizontal axis, we have the implied volatility. On the vertical axis, we have the actually realized volatility on that index over the next 20 days. So essentially, as we can see, well, there is some type of a correlation here. So as the implied volatility is higher, then what we expect to happen over the next 20 days is also higher. However, of course, this correlation is not perfect. So we see quite a lot of noise here. This is number one. Number two, well, what we can see is that there are kind of two different regimes. So if you look at the upper part of the chart, so it looks like as if it's still not predicting that we're jumping from a lower risk to a very high risk regime. And last but not least, so here we are talking about an estimate over the next 20 days. And if we think about like a long-term investor in a Coco bond, so it's like a horizon of 5-10 years, maybe more. So risk measures, implied risk measures from the market, they can explain the forward developments of the markets, but this is only in the short term, only partially, only to a limited extent. So it's not enough. finally, what is very interesting or very relevant specifically for cocoa bonds is what is kind of known as a tension cascade. So as soon as there are bad news for a certain bank, so basically what their market reaction will be, people will start to short its stocks. The spreads of the bank will increase, meaning that the bank will have probably more troubles to raise liquidity in times of need. So in a way it can turn into a kind of a self-perpetuating mechanism. So bad news trigger more bad news, which trigger more bad news. Well, at a certain moment you reach the trigger and the cocoa needs to be fired. This is kind of a topic which is widely researched in the area of behavioral finance. So here I have a quote from the Nobel Prize winner Schiller from his book Irrational Exuberance, who says, well, a careful analysis reveals that the news appearing in the media, they are important in both setting the stage for a market move and in instigating the move itself. So this is specifically dangerous for cocoa bonds. There is an old saying in my country, you can kill a fly and a bank with a newspaper. So understanding the newspapers is an important part of understanding the risk in cocoa bonds. Okay, so what we want to achieve within the market trust, we want to build a bridge between what is like a more long-term credit risk analysis and what is like the more short-term valuation or market risk sensitivity of a given instrument. So why is that helpful? Well, so if we can, so a bridge you can work in both ways. So if we have the valuations, or if we have certain market observable parameters, then we can obtain credit ratings which are fully data driven, and therefore we can identify maybe risk earlier than what the traditional rating agencies will do. Then at the same time, once we have the ratings, we can get, let's say, more fundamental analysis of the price of a given security, meaning that we can estimate its fair value in a more strategic way, and also kind of identify mispricings available in the market. We can also